Hey everybody, good to be here today. It is Wednesday, and that means it's time for managing an options portfolio. My name is Brent Moores, and we're going to go through a variety of option trades today, talk about managing them, looking at your overall portfolio, and some considerations, including reward to risk considerations when you're both entering trades and also considering whether to exit trades or manage trades in some way. We're going to do that in just a minute, but let me just mention a couple things. One, I'm joined by Connie Hill in the chat. Connie helping me out. Appreciate her. Encourage you to check out her Straddles and Strangles webcast. That occurs on Mondays, 11 o'clock Eastern time, I believe. And great webcast, by the way. So it complements this class, I think, pretty well, too, because sometimes we talk about managing these types of trades here. Also, you can follow us on X, at Brent Moore CS, at Connie Hill CS. And I appreciate each of you taking some time out of your day joining me. Before we go too far into this, though, let me just mention a few important things. One, options do carry a high level of risk and are not suitable for all investors. And multi-leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the material today is intended for general, informational, and educational purposes only. Rolling strategies can entail additional transaction costs. Paper money software application is provided for educational purposes only, but it doesn't assign short options early. That's different than your live account. For the sake of simplicity, I'm not going to factor in commissions and fees in these trades that we look at, but they are considerations that you should factor in. Yeah. And Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. Let's head on over to the Thinkorswim platform. And this is the S&P 500. Today we have an update today. We had a nice uptrend. We've been kind of sideways, potential resistance, potential support, kind of this sideways channel. What's going to knock us out of that? I don't know, but I'll tell you, there's kind of three kind of bigger earnings coming out today after the market closes. One you may be aware of is NVIDIA, and that's the largest company in the world by market cap. Also, Snowflake is coming out with earnings, and Salesforce, CRM, is coming out with earnings. So they can all push the market. But in fact, what I was thinking of doing is maybe looking at a quick NVIDIA trade in light of the topic that I want to talk to you about today. And that is reward to risk. So we actually already have a short put on NVIDIA, but I'm going to look at something different. I'm going to look at NVIDIA, and I'm just going to take I'm going to say, well, we're kind of breaking out of here. Now, of course, big caveat is anytime there's earnings, whatever technical analysis you do can kind of go out the window to a certain extent, because the news of earnings can trump any technical analysis, support, resistance trend that you have. But having said that, I'm going to do kind of a bullish trade on NVIDIA just to get us started here. So I'm going to look at NVIDIA, and I'm just going to do a long call vertical. I'm going to take a more of a bullish stance on this. Again, earnings, who knows? But let's go to the trade tab. And I'm just going to go out. I don't need to go out very far. I'm going to go out just a couple days. This is a trade specific to earnings if I want. Now, I can go out a couple days. I can go out a little more if I want. These are just weekly options. But it's just a short-term trade specifically for earnings. The stock right now is about 197. So what I'm going to do is I'm going to go and let's do like a 192.50 long call and a 202.50 short call. This is a spread trade right here. This is a spread trade. And the cost on this is just above $5 here, maybe a little bit more, okay? Make it easy with the numbers, we'll make that 510. Okay, 510. Now, if I go, and where do I want the stock to go, first of all? Well, for the long option, that's the 192.50, to have any value at expiration, it would need to be above 192.50. We want, that's kind of the minimum we want, but we'd still be losing money at that point. Really, what we wanted to do is, first of all, go higher, but above that 202.50 at expiration would represent our max gain on that. Okay. Now, but of course, before expiration, it's a different story. Before expiration, we're not necessarily at a max gain just because we're at 202.50 or at max loss just because we're below 192.50. But let's take this trade, and I'm just going to confirm and send, and let's look at the max profit and the max loss. So my max profit on this is 490. My max loss is 510. All right, and what I'm going to do is I'm just going to put this in my long verticals bucket there, and I'm going to send this order, and it's thinking. But let's look at this, okay? Actually, I want this to fill here, so I'm going to just move this up a little bit. Oh, it just filled. Okay, there we go. So let's go and let's look at the Analyze tab on this. And on NVIDIA, I have NVIDIA, I have a short put here that's unchecked. So we're just looking at the trade we just did. And let's look at 228, that's expiration. Let me set my slices to break even. This should be roughly a 50-50 trade, roughly 50% trade. And as we said, our max gain here is, it changed just a little bit, about 490. Our max loss is about 510. That's how it is right now. But let's envision this. Let's say the stock goes up. Let's say it goes up to about 210. Okay? And I'm not going to worry about the date. I'm just going to say it goes to 210. At that point, that our reward to risk, which right now, as we entered, was 490 to 510, that reward to risk is going to change to a certain extent at that point, because at that point, we said 210, we will have made, if it were to turn out, I'm just going to kind of round, about $300. In other words, of the $490 max gain, now when I say made, it's not a realized gain, okay? Let me just make that clear. It's not a realized gain, but if we close it out, we would expect to close it out with about a $300 profit. So we would have an unrealized gain of about $300 at that point. In other words, holding on to it, the best we could do using our theoretical gains and losses is only make about $190 more. Now, how much could we lose at that point? Well, at that point, we could still lose, if the stock completely reverted itself, all the way down to that $510. Okay? So right now, my reward to risk is 490 to 510. At that point, my reward, my realizable remaining reward is 190, yet my loss is about 510. Now, that doesn't factor in my profitability, my probabilities. Right now, my probabilities are like 50-50, right? At this point, my probabilities are much better. If I were just to hold it all the way to expiration, which is only a couple days out, until for it to go there. Okay, so my point is, when you start out your trade, let's say you're entering a fresh trade, understand your reward to risk starting out and your probabilities. Okay, my reward to risk is roughly 50-50 here. Okay, basically 100% if I took 490, okay, 490 divided by 510, that's a good question, A-Trades. We'll get to that in just one sec. Basically 96% return on risk, okay? So we're standing to make just a little bit less than what we could lose on this. Know your probabilities, but also know your know your reward to risk, your profitability potential versus, and know also your probabilities as well. That's the first thing. As the trade progresses, those change. Okay, so this is just a real simple example. Now, in the chat, someone said, "Do you adjust volatility after?" Yes, we can certainly adjust volatility after earnings. It's probably not going to make that big a difference in this case, and here's the reason why. Let's say the stock stays right where it's at. Okay, let's say the stock is right where it's at. I have a long call. At, well, at the 195 level. I have a short call. Well, actually, not 195. It was 197.50, I think, or 120. Sorry, what 192.50 is my long call. 192.50 is my long call. I have a short call at 202.50. We're basically equidistant from both of these. Okay? The long call is positive vega. We're probably going to get a drop in implied volatilities with earnings, right? I mean, I can't say 100%, but very, very likely we're going to get a significant drop in implied volatility with earnings. My short call at the 202.50 level is negative vega. This vega just tells us how the option contract is going to react to a change in implied volatility. We're likely going to get a drop in implied volatility on both of those. One of those is going to help us out. One of those, the short one, one of those is likely to hurt us, the long one. Because we're kind of equidistant right now, they're probably going to be largely offsetting here. And the reality is there's not that much, there's only 2 days to go till expiration. So it's only going to affect it only affects the extrinsic value of those contracts. It's probably less likely in this circumstance to have much effect on the contracts than others. And I don't want to go too far down that rabbit hole right now. We talk about volatility quite a bit in this class, and I think it's an important consideration. But for this trade, I just want to focus on the reward to risk. But it's a great question there. Now, could I have done this as a short put vertical is another question. We did a long call vertical. I could do this as a short put vertical. One challenge with doing this as a short put vertical is that if we did that and we did these same strike prices, I'd have a long put right here. I'd have a short put right here. That would actually be in the money currently. So we'd be starting out with an in the money short put, which some traders would try and avoid. But you certainly could do it, and the pricing would probably be pretty similar, Harry, there. So it's a good question. Okay, am I going to take it to expiration? I'm not going to take it all the way to expiration, but after earnings. Earnings is in a few hours from now. So tomorrow we'd probably look to manage this trade here. All right. Okay. Now, so that's my first thing. I want to reward to risk changes over time. Let's look at some examples of this. I'm going to go to short verticals here. Okay. I'm going to go to short verticals. So that NVIDIA trade, by the way, I won't have a class tomorrow, but we'll look to get out tomorrow on that NVIDIA trade. All right. Here's Apple. I have an iron condor on Apple. And I kind of want to consider these one spread at a time. So I've got a short put vertical here, and I've got a short call vertical here. It's an iron condor. So I have those trades. How much can we potentially make on the spread? How much could this spread potentially be worth? Well, there's a $5 difference in these, but on a short put vertical, our best scenario is it goes to zero, right? It expires worthless on a short put vertical. That's what we want. That's we'll say our max gain, our theoretical max gain on that. How much could, not max gain, that's not the right terminology. That's the best scenario, okay? It expires worthless. So this is the good scenario. It goes to, the bad scenario is $5 difference, the spread width on this. So it could go to $5. We don't want that because that means we'd be buying it back for $5. That's no good. How much is it worth now? Look at the mark price. The difference between those, it's worth about 11 cents right now, approximately 11 cents. In other words, if it's 11 cents right now, and the best it can get to is 0, and the worst it can get to is 5, we've made almost everything we can make on this trade. Is that making sense? Now we can decide, hey, look, it's probably going to stay out of the money. And therefore, I'm just going to let it run, and I'm going to collect that extra $11 on the trade, or actually $22 because there's 2 contracts on that. Or you can say, I've made almost everything I can make. I'm just going to take this off. For the reason being twofold. One, there's always a chance, probably slim, but there's always a chance it can go against us. And if it goes against us, it can go way against us, whereas there's not much left to go on this. And secondly, it's presumably frees up some capital for other trades there. So I'm going to look to exit the put contracts for that reason. I'm hoping that is making sense. Do you see how the reward to risk has changed on us, though? I don't know what it was to start, but right now, what is realizable in terms of improvement of our current position, there's not much more reward we can get on this at this point. Yet there's still a lot of risk. So that has shifted. So we're going to close out of the put side of the contract here. We've made our money on the put side. So I'm just going to close out of that. I'm going to just highlight those. I'm going to create a closing order, and I'm going to buy it back. We're going to confirm and send. Let me just do that. Confirm and send that, and get out of the puts. Okay. Now, let's go back here. We still have the call side of the equation. This is the ugly side of the equation. This is the one that's not doing so well. Let's do the same thing, though, that we just did. How much more could we make on this? Well, this could go to 0. The current price is what? Well, let's look at the mark. We're about $2.30 is what the current pricing is on this right now. Do you see where I got the $2.30 from? I just subtracted $3 from the $5.30. Okay, so that's what the current value of this is. The best case scenario is this goes to 0. The worst case scenario is this goes to 5. Okay? So basically, there's a lot more we could gain, and there's a lot more we could lose on this trade. Now, things are going south on us, but we still have 16 days to go. So there's still time on this. So it can certainly get worse. And on this spread, we're losing money right now. but we can certainly lose a lot more money on this. Remember, there's 2 contracts on this. So the question is, do we still think this seems like a reasonable trade? And for that, I'm going to turn to technical analysis. In other words, do I think it's reasonable for the stock to stay below 275? Because that's where we want the stock to stay, below 275, right? And if the answer is, this looks really bleak, I don't think there's much chance it's going to stay below 275, 280, then we're probably just going to take the loss that we can get and salvage it before we take a bigger loss. But let's look at the chart. We're going to Apple, and where do we want it to stay? Well, we want it to kind of stay below 275, which is right about here. Here's our spread, 275, 280. I'm willing, and this is just a total judgment call. You may come to a completely different decision than I do on this one. This one I don't think is very clear cut. I'm willing to say this seems like a reasonable resistance. We've had a good run, but there's a good chance it's going to revert itself here. And remember, anything below 275 at expiration is a max gain position on that short call. So really, we just need the stock not to go up more. Well, right now there's some upward momentum on it. There's no doubt about that. But I'm willing to let that sit. We're going to let this sit a little bit longer. So I'm going to leave this untouched. So we managed out of the short put. We took our winners. We're going to let the loser sit here for a little bit longer and see if things can get better. But that's one I can see going either way on there. Okay? So hopefully you understand my rationale on that. You could certainly come to a different conclusion on that. Let's look at Bank of America. Bank of America expires in 2 days. It's a short call vertical. Regardless of whether we're doing well or not so well, that's going to be, it doesn't matter. We're only got 2 days to go to expiration. We're not going to let this go all the way to expiration. That's our rules in this webcast. On short verticals, we get out once we're under the 10-day to go mark till expiration. All right. So I'm going to stick with it for that reason. But let's just I'm going to go a little more quickly on this one. But let's look at that. Let's look at the reward to risk ratio. What's it currently worth right now? Well, what could this be worth? Well, there's a $1 spread. So the best case scenario, short vertical, is it goes to 0. Okay. How much left do we have on this? Current mark price, 8 cents and 1 cent? It's worth about 7 cents right now. Okay. We got 4 contracts, but the reality is we've made almost everything we can make on this trade at this point. And it could certainly get a lot worse, right? It can get a lot worse. Therefore, hey, we've made the money. We're going to get out. The alternative thing, so we're just going to follow the rules here. The alternative approach is to say, and this is a viable thing, is to say, look, this is out of the money. The stock's at 51.60. As long as it stays below 53 at expiration, we're probably in pretty good shape. Therefore, I'm going to roll the dice, so to speak. In other words, I'm willing to take that risk and let it go the next 2 days. We only got 2 days, and just try and ensure that we get the last little bit of profit there. However, there's just not much left on it. So we're probably going to look to get out of this trade, and that's what I'm going to do with that right at this point. So I'm going to get out of this trade. Notice how the reward to risk ratio at this point has switched. There's a lot more risk remaining in this than potential additional gain on this. So I'm going to buy this back. I'm going to confirm and send. I'm going to send that and look to get out. All right. So that's thinking. We'll let that cook there for a little bit. Let's go to IBM. Again, short vertical. We'll get some other types of trades, but we'll look for short verticals now. I've got 23 days to go, so there's no urgency to get out. How much is left potential in this trade? Well, the current value is about 5-6 cents. Okay, 5-6 cents. We'll say 6 cents. What's the best case scenario on a short put vertical or short call vertical? It goes to zero. So if we close out now, we're leaving a little bit of money on the table, so to speak. But it is something that may be worth it to got a little profit here. So $75, take that and run, because there's just not that much more to go on this trade. Okay, so I'm going to get out of this trade. I'm going to highlight this, right click, create a closing order. I'm going to buy this back. Okay, and I may have to buy back for a little bit more, confirm and send the effect. It's thinking. Okay, we'll let that think and go. All right, NVIDIA. What do we have on NVIDIA here? This is not the NVIDIA trade we just did. We did a long call vertical to kind of start off our webcast today, but this is a separate NVIDIA trade. This is just a short put. Now I put a note next to this, and basically it's the wheel strategy. We talked about this. Was it last week we talked about it? Maybe it was a couple weeks ago in this webcast. We talked about the wheel strategy. The point on this is we're willing to buy NVIDIA. Normally, if you don't want to get assigned on something, when we're under 10 days to go, we'll probably just look to exit. Or another way to view it is this. The current price is just under $2. We traded it for $4.65. We've made over half of what we can make on this, 57% to be exact, I guess. But we're willing to buy the stock here. That's the goal. That's the wheel strategy that we talked about. We go, and if we end up buying the stock, we buy the stock. And then we're going to sell a covered call on it. But for now, we're just going to let that sit. Okay, so that's the rationale on NVIDIA. Most of these short options, we're looking to get out when we're under 10 days to go to expiration. NVIDIA is the exception, because we're planning on buying the stock if it goes. Now, we wouldn't be buying the stock here on SPX index options, because SPX options are European style options. For those of you who aren't familiar with this, there's two general kind of options we deal with. The vast majority of the time, we're dealing with American style options. American style options can be exercised or assigned anytime before expiration. Okay? And so that's one of those little disclaimers we always say at the beginning of the webcast, those disclosures. We say options can be assigned at any time. Well, not European style options, SPX options, and for that matter, like RUT options or NDX options are the same. They're European style options. They can't be assigned early. There's no stock underneath this. This is an index. There's no such thing as SPX stock. This is an index. And so this gets cash settled. It doesn't matter though. We got 1 day till expiration on this. And I could just let this go to expiration. One of the reasons why we don't let things go to expiration is this risk of early assignment. Also, there's always the risk of you end up with stock that you don't really want to end up with. This is cash settled. This is a cash settled index. And so it would just be a change in cash here at this point. So I'm willing to let this sit for a day for this to expire. The index right now is at 69.36. It's in between both of these, kind of safely. Well, I won't say safely. I don't know. Who knows what the market could change significantly here. But I'm willing, even if this were to go in the money a little bit, it's cash settled. So I'm not going to be buying any stock here. So we're just going to let that sit here. But that was a trade on an index option. And there's an index options webcast that we do. I don't do that many index options in this webcast. Occasionally we do them. But as, thank you, Wiley, in the chat mentioned, we have an index options class. And it's on Wednesdays, 3 o'clock Eastern time, if you're interested in that. Okay. So there's our short verticals, our short puts section here on this. Let's go to another thing here. All right. We'll just kind of go in order here. Caterpillar. Caterpillar is a LEAPS option. In other words, it's a long-term option. Notice 324 days to expiration. Okay. The way we're going to treat this, the way we're going to manage this option is we're going to manage it more like a stock, a longer-term stock hold. It's not a stock. There's differences, no doubt. This doesn't pay dividends. This does expire eventually, or a couple differences there. But so as long as we're generally bullish longer term on this, we're going to say we're willing to stick with it. Well, look, let's look at Caterpillar. Are we still bullish on Caterpillar? Caterpillar we've had for a long, long time. We've rolled it a couple times. And this is the general trend that we've had here. Any reason I don't see anything technically that's just completely breaking down on this for the long term, so I'm not going to look to get out of this. We may evaluate our stop here on this, though. Our exit right now is, we have an exit on here. It's based on the underlying stock when the stock is under 610. Okay. Should we move this up? Well, that's down. It's actually, let me move this just a little bit. Our current stop is right here. Maybe that's a little loose. Maybe we move that up a little bit. I don't want to move it up real tight because this is intended to be a longer term hold. I'm not going to move it up above that 20-day moving average. But maybe instead of 610, maybe we move it to 650, right below that 50-day moving average. That may make sense. So what I'm going to do here is I'm going to just click on that. I'm going to right click and I'm going to cancel and replace this. And I'm going to go right here, click on the gear. And instead of 610, we're going to say 650. This doesn't absolutely guarantee that it's going to sell out if Caterpillar goes to, it's going to get out right when Caterpillar's at 650. But this is a kind of a standard risk management tactic with options trades. In this case, we're using the underlying stock price of Caterpillar Marks. So I'm just changing that. Confirming it's sending that. So we've adjusted that. And for that reason, I'm going to adjust my note here and make that, I think we said 650, right? Save that note. Okay. So we've adjusted that stop price on Caterpillar. I think, let me just check on time. We're doing okay. Capital One Financial, another LEAPS. Okay. How do we manage a LEAPS? Well, like we would a stock, but this is a put. This is a LEAPS put. Okay. And so there we go. As long as we are long-term bearish on Capital One Financial, we're likely to stick with it. Are we still bearish on it? Let's look at it. Here's the stock. Trend is down. It's come back the last couple of days, but that hasn't changed the general trend, right? That's the general trend. So I'm willing to stick with that for a little bit, but let's double check our stop on this. I think I have a note on that. Less than 230, greater than 235. Okay. 235. So let's look right here. That's right here. That's where our stop currently is on this, or our exit is currently right there. Can we tighten that? We could probably tighten that a little bit. I don't want to get out right here, but if the stock continues to break this trend, instead of 235, maybe 220, does that seem reasonable? Let's move that down. I'm going to do the same thing. I'm going to click on this. I'm going to right click. I'm going to cancel and replace this. And click on the gear. And I'm going to do 220. Save that. Confirm and send. Send that. And then what I'm going to do is I'm going to just change my note to reflect our added stop. Now, Wiley said, sell a short-term put on Capital One. You could. You sell a put. That's a bullish position. I'm not going to do that right now, but that's certainly, you can always add in additional trades here on this. If I add in a short-term put on, we'd be basically creating a diagonal spread there on this at that point. Maybe topic for a different day here. Question in the chat. When did I initiate the catch rate? I don't remember. January 14th. Okay. This actually, we've had it many months, but we've rolled it. Okay. So not the exact same trade because we rolled it, but this particular version of it is January 14th, it looks like. Let's keep going. Okay. Philip Morris. This is not a leaps. So we manage them differently, right? On a leaps trade, we manage it like a longer term trade. This, it's a shorter term trade. Let's look at it. Philip Morris. So if the trend is like, if it's not trending up, let's just talk about it. Let's say we have a leaps contract and the stock is just kind of going sideways for a while. That's okay. We're probably willing to stick with it for a while. Okay. On this is a shorter term trend trade. As long as it's trending up, we're going to stick with it. But if it starts to go in this extended sideways, that trend isn't working, we're probably going to look to exit. Is the trend still going up? Yeah, the trend's still going up. So we're going to stick with it. Now, especially with 23 days to go, we're starting, time decay is working against us. So if it's not doing well, we're not going to stick with it. But I think I'm going to stick with it in this case. I've got a $15 stop on this, on the option. The current option is $30. So I can move that up. I can probably move it up substantially. So instead of 15, look, our delta is basically 100 on this right now. And that means it's done very well. So we could probably move that stop up to like 80% of that price. Well, 80% of 30 would be $24. That'd tighten it up substantially from the $15 stop. So I'm going to move that stop up. I'm going to right click on it. I'm going to cancel and replace this order. And I'm going to move it up to $24. Confirm and send. Send. We've just adjusted the stop. Now, let me just back up one sec because I just went through something. I just did a stop on an option. Okay. I did a stop not on the underlying stock price, or not, we didn't base the exit based on the stock price. We based it on the option price. So how tight do you do those? Well, part of it's probably going to depend kind of on your delta. If your delta, let me just give you a couple scenarios here. Let's say your delta is about 50, okay? And then let's do another scenario. Delta is about 100. And I don't know, maybe we'll do one more. Delta is about 75. And there's no hard and fast rules here, but I'm just kind of giving you some general guidelines. Options are quite volatile. And so when you're doing a stock and you say, well, I'm going to put my stop 5% below the stock price or something like that, that may be reasonable. It may be tight, but it's possible, it's reasonable. You put it 10% below the stock price. That's certainly, that's kind of a typical type stop loss. On options, generally, you can't do them that tight. So if you're doing something with, say, a 50 delta, your stop is probably going to be something like 50% of the price, maybe a little higher, maybe 60% of the price. But because of the volatility of those options, of how much they bounce around, if you put it too tight, if you put it at 70%, 80%, what you're looking at is something that's liable just to get stopped out intraday on just a quick intraday switch on that. So you can't do that. With an option, we'll say 75 delta. Well, it's in the money. It doesn't move around as much. It's not as volatile as the 50 delta. So maybe on that, we'll do something like 60 to 70% of the stop of the price. And with 100, this is what we just had. We had something 100. Often it won't be 100. It'll be 95 or something like that. That means it's in the money. It's not as volatile. So we can make it even tighter. In this case, I did something about the 80% mark in that example. But so if you're doing the stop, not based on the underlying stock price, but on the option price, and you're looking what level should it be at, you may consider kind of using delta as a measure of how volatile that's likely to be. Now, what is delta? Delta is telling us how much that option price is going to move compared to a $1 move in the stock price. But on a percentage basis, we can also say that's kind of giving us a leverage perspective of volatility there on that. So some of you maybe don't even always do it based on the underlying stock price, and that's okay. But I like to do them both ways here in this webcast, and this is one that we just did based on the underlying stock price. Now, we're starting to get low. We're getting very low on time, so I want to just kind of whip through some others here. Let me mention this real briefly. This is another LEAPS. So everything I said before on the other LEAPS is going to hold to this on this one, okay? As long as we're still kind of bullish on this, we're probably going to stick with it. But notice this doesn't have a stop on it. I'm probably going to add something in. I'll do that after the webcast, though, because I just don't have time, because there's something else I want to show you. Let's look at a couple. This. What are the... let me get rid of this. What are these trades? They're both the same. Now, you may be tempted to go and say, that's an iron condor, Brent. But notice an iron condor would have a short call vertical. This is a long call vertical, okay? Oh, here's a short call vertical. An iron condor has calls and puts. There's two call spreads on this. This and this are long condors, not iron condors, long condors. If you're interested, it's not a trade we do very often, and we'll look to manage these in future weeks. But if you're interested, I did a webcast on long condors, not iron condors, last Friday in the Condors, Calendars, and Butterflies webcast. I just put a link in the chat for those of you in the chat there. And you can always find it. Just go to YouTube. You're on YouTube right now. Just go to the Trader Talks webcast, which you're on. Subscribe to it, first of all. And then on the channel, Trader Talks, go to the playlists. Go to the Condors, Calendars, and Butterflies playlist. You'll see the very last one, assuming you watch this in the next few days, will be that long condors. If you're interested, check that out. Okay. Now, I'm at time. I appreciate you guys. Thank you for joining me today. We talked about reward to risk, how that changes through the life of an option trade. How what made sense initially may change over time. If you've made most of what you can make, or if there's not that much more to lose. We didn't really go through that scenario, but specifically, but that's a consideration. What's your remaining reward on this trade if you continue to hold it? What's your remaining risk is something to always ask yourself. All right, I appreciate you joining me. Appreciate Connie in the chat. Thank you very much for joining me, everybody. And coming up next, we've got trading price patterns. So make sure you check that out. Everybody have a wonderful rest of the day, and we'll see you same time next week. Bye-bye, everybody.